In this week's update, the best news of the year, how the Fed could stuff it up, and gold back to all-time highs. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with a normal market perspective. US inflation continues to head in the right direction. The CPI data that came out through the week was the best, in inverted commas, depending on how you frame it. But it was certainly good, and some would argue it was the best CPI data reading in 4 years. So things are certainly on track, and it would appear that the Fed has done a good job. But it's almost raising the question now, is the Fed waiting too long? Is there enough evidence there now with inflation and with jobs data that the Fed should be cutting rates now rather than still talking about holding off and trying to talk tough? So we'll see, but there is a chance that the Fed could be moving already, and that if they wait too much longer, they may see the economy deteriorate more than they would like, because there is a big lag effect here. So you can't wait until you see the elephants almost on top of you. You've got to move early. So that's really the question. But otherwise, from an inflationary point of view, and therefore the potential for easing interest rates, it's all heading in the right direction. So that's really good news. The other bit of good news is that we did see a reaction in the market on Thursday with big tech selling off, and selling off fairly sharply. But there's a but there, and I'll get to that. But the good news is that there was major stock rotation. There were new records set, but importantly, the breadth of the market improved. So this is the sort of thing that sustains bull markets for the long term. The fact that the baton gets passed on to somebody else and the buying momentum gets continued, but it gets continued in other stocks. So that is also a very good situation. Is this a lift-off for all those stocks that have been left behind? There's been a huge big tech frenzy, particularly in the last 12 months. And a lot of quality stocks that are growing their earnings and doing all the right things have just been scrambling for air, and nobody's been terribly interested. And as a result, we're seeing stocks in some cases that are producing earnings growth of 30, 40, 50% and above, trading on either single-digit PEs or low to mid-teens PEs, so significantly undervalued with a terrific runway for growth. So I'm getting very, very excited by a number of those. There are also numerous Aussie small caps that are doing similarly. And I think with that rotational shift into maybe more value stocks in the States, that we may see that start to filter through into Australia as well. So lots of opportunities, because there are plenty of good stocks in Australia that have not really been trending. They've just been going sideways, yet the businesses have been improving. So there's certainly fertile ground for quality growth and value stocks in Australia to do much better. So what could go wrong? Well, there's a couple of things. Obviously, an earnings contraction, and with the US earnings season having just started on Friday, we're at the very beginning of that. So over the next 2 to 3 weeks, we'll get a good fix on what the earnings situation and particularly the outlooks statements are going to say. So that would be one, and that's a bit of an unknown at this stage. But certainly Wall Street knows in advance what's unfolding, and so far we're seeing a lot of positivity. So I would be very surprised if earnings contract to a degree that is going to upset the market. There could be a significant geopolitical event, particularly around, I think, things in the Middle East and Europe. I don't think are going to disturb the American stock market, but certainly a conflict with China could certainly have that impact. And of course, this morning, just before I started recording, the news has come through that someone's apparently had a crack at Donald Trump. That could destabilise the market a little bit, but look, I think it would only be extremely temporary, but we'll see what happens on Monday. So they're the two things that, and we can't control those and we can't know them. So from my perspective, things that you can't know and you can't control, you don't worry about, because otherwise you'd be looking over your shoulder your entire investing life. You just got to get on with it and manage risk and select the highest quality stocks. And if an event does come around, then that stock may dip, but it'll bounce back if it's a real quality growth stock. So they're not things that keep me awake at all. Now, outside of a war in the Asia Pacific, there is every reason why a quite meaningful number of US stocks should keep rising, because they've just got the growth, they've got the earnings, they've got low levels of debt, and most parts of their business appear to be very sustainable. But you've got to filter through an awful lot of stocks to find the ones that have a very high probability of continuing that earnings growth. I also expect that the most powerful trends in our market across multiple sectors, so technology, industrial, healthcare to a degree, certainly some parts of mining are doing really well. Some stocks are trending very, very powerfully, and I'm not talking about specky stocks. I'm talking about stocks that have got some merit. So that's happening right now, and I don't see anything that's going to shift that. So certainly plenty of opportunity. Let's go to the charts. The US market S&P 500 rose just under 1% across the week, but the NASDAQ was down, and that was because of the fairly abrupt treatment of the top 10 stocks on Thursday night. So the NASDAQ ended down 0.3. I'll have more to say about that when we get to the charts. But this is the really big story, and that is that the equal weight S&P index, the RSP, closed up 3%, and the Russell closed up a massive 6.1%. That is a huge move for an index that covers 2,000 stocks. So that really is that's the good news, and that's just such good news for the market sentiment as a whole, that so many stocks are now getting that money flow and that support. So this is a rotation that frankly was overdue. It's been overdue for some time. It's healthy. It's great news. So I wouldn't be concerned about where that is heading. And when we get to the charts, you'll see that whilst the candles might look a bit ugly, if you look at the whole picture, it's nothing terribly much to be worried about, in my opinion. So my conclusion is that the consolidation in big tech, which is absolutely necessary, is likely to be shallow. There's no guarantee, but likely to be shallow and likely not to last terribly long. The signs are not there that would support something more significant. The US dollar index was lower, almost back down to 104. The yield, the bond market, is absolutely shouting at the Fed that they think lower interest rates are warranted. So the 10-year yield was down to 4.18, and the VIX has remained steady now for a number of weeks at around 12.5. All right, let's jump in and look at the charts. I'll start with NVIDIA because it's such an important influencer of market sentiment. So we've had a parabolic move, and whenever you look at things like this, I got a couple of emails on Friday morning about the NVIDIA reversal, because that candle in isolation looks ugly. But you've got to look at the whole context to get an accurate assessment of what's going on. So we had a parabolic move. In fact, you could really say it started back here in January, but let's take the most recent. So we've moved from 90 to 140 in a very short period of time, just in a couple of months. And then we got a significant gap up and reversal, accompanied by an increase in volume, but not particularly spectacular. So that one didn't foreshadow something more serious. We then got immediately a bit of indecision the next day. So this wasn't another smashing follow through the following day. It was a bit of indecision. And then we got another down day, significant down day with a gap, but the volume's starting to tail off quite dramatically. So far, so good. We've come down, we've filled the gap, or sorry, we didn't fill the gap. We got to the top of the gap support, and then that was it. So looking a bit technical, to be honest. Now, we then got a bounce. The bounce was on very low volumes. So a bit of a sign there, not much in the bounce. The bounce formed a lower high. Now, we got another nasty looking candle, but look at the volume. Not particularly elevated, really. And look, this may end up going lower. I think the likely area, from what we can see at the moment, is here between 118 and 116. Now, it's possible we could come back down into the mid-90s. It's possible, but I don't think, looking at this overall pattern, I don't think that's the most likely outcome. In fact, I think that's a slim chance of occurring. More likely, we're going to bounce around in this area here for weeks, possibly a few months to consolidate. A few months would be good. A few months would be better than a few weeks, because it just gives the market time to adjust and for the money flows to settle down. So overall, I'm not seeing anything terribly dramatic about this overall pattern, but we'll see. Let's keep an open mind on all this. And if we look at some of the others, Meta, similar, a reversal on Thursday, indecisive day Friday, nothing much happening with the volumes. Microsoft, very similar, you can see, not much happening with the volumes. And Google, pretty much the same. So when you work your way through the top 10, there's nothing terribly dramatic there. And we saw, in fact, SMH, which is the semiconductor ETF, actually rise on Friday. Closed off its highs because there was some selling in the last hour, but yeah, there's just nothing there that really concerns me. And there is the NASDAQ, so down just a fraction across the week. If we look at the S&P, so the S&P finished up a little bit on the week, but the big news is the RSP certainly doing much better than the S&P did, and some higher volumes. But it was the Russell that I think is the one that's looking particularly good. That's on a weekly chart. So it tried to break out, bit of consolidation for a few months, but with the actual price movement on Thursday and Friday, huge gap and big move on big volume on Thursday, and then we got good follow through on Friday. So that is extremely positive. There's just looking at where the money flows are going. There's the semiconductor index versus the S&P, so nothing to see here. And if we look at the relative comparison charts over the last quarter, XLK is still leading the way from consumer discretionary. Healthcare certainly making a more positive move. And we've got materials and energy at the bottom. Let's zero in a bit over the last month, and you can see an improvement in consumer discretionary. We certainly saw technology come off a bit. Finance still doing reasonably well, and communication services taking a bit of a rest. And then we've got staples and materials towards the bottom. So nothing really has changed all that much other than this quite significant rotation. And I mean, that's really good. If you missed the boat on Nvidia and Microsoft and those sort of stocks, then you've been, to a degree, starved of opportunity, and you may now well get that opportunity in spades. So that's how the US market shapes up. Let's look at the currency. So this currency is very much in keeping with the lower bond yields. The market is expecting rate cuts sooner rather than later. And our market, of course, went the other way, and we're back almost to the top of this range that's been in operation now since the middle of last year. All right, so that's the American market. Our dollar finished 67.2. The ASX 200 ended up 1.75%. I really don't have much of a feel for how it's going to open on Monday morning because the US market did sell down in the last hour. So that would have a negative effect. And I have no idea what the market reaction to the Trump situation will be on Monday. I just can't see that it's going to have any sort of lasting impact at all. Yeah, there might be some emotional impact to it, but I think in terms of an ongoing impact, it shouldn't matter. Healthcare certainly grabbed the leaders. Guernsey in Australia had a good week across most of the healthcare majors. And there are also some pockets of real mining brilliance, some very, very powerful trends. And when you look at the commonality amongst those stocks that are doing really well, almost all of them are associated with management that justifiably has a terrific track record and is regarded by are regarded by the market as the best in their class. And it's so important, particularly with mining development stocks, that you have really, really good management, because not only do they get the job done, the market expects them to get the job done and rewards them in advance. So I cannot stress enough the importance of who's running the show in terms of mining developers. And if you've got also ran management that doesn't have any skin in the game, then it's almost an investment that I just wouldn't touch. So that's the Aussie market. Let's just have a quick look at the charts. I'll just go back to the relative comparison chart. So this is the Australian market over the last month. So you can see healthcare has really shot up very strongly. Finance, which is a real head scratcher because the banks in Australia are so overvalued. I think if you're buying them at this level, your average return over the next 5 years, by definition, has got to be quite low. You can't pay top of the tree prices and valuations and expect to get outperformance. So that's a bit of a head scratcher. We've seen a bit of an improvement in energy. Small caps is really come to the fore, particularly in the last week. It's been a very good rise. So I think we're probably going to see more of that. All right, let's move to the precious metals market. This is gold in US dollars on a weekly basis, and we're now back up to all-time closing highs, above 2,400. And irrespective of what your bias might be, whether you're a gold bull or a gold bear or what you think might happen, you just got to step back and look at that chart. From 2022, a series of higher highs and higher lows, a really robust breakout that didn't ever get a retest of the breakout. We've consolidated high, and now we're off again. You can only interpret that chart as extremely bullish. There's just no other way to slice it. So that's very positive. In Australian dollars, not much movement because the Australian dollar has firmed as well. So that hasn't benefited our miners, but the margins are still pretty healthy. And if we look at silver broke out, pulled back under the 30 mark, but is now trading back above it. So to summarise, gold up $21 to $24.12 or $35.63 in Aussie dollars. Now that was a fair bit about the cooler than expected US inflation, so that's obviously beneficial for gold. I think producers are certainly entitled to catching up, and I've been talking about this for weeks now, or in fact months, the fact that gold stocks on a valuation basis relative to the gold price are at 20-year lows. So producers are certainly entitled to catch up. And we're now seeing more rapid earnings per share growth than we've seen for a long time. We're seeing expanding free cash flows, and we're also seeing expanding operating margins. If gold stocks cannot make ground relative to the gold price, then I don't know what will ever get the prices moving, because this is about as good as environment that you could get for producers. Now, when it come down a level to the more advanced developers, there is going to be increasing mergers and acquisitions because the larger fish at the top of the tree are running out of resources. So M&A is absolutely inevitable, and it's already underway, has been for some time. So it's going to continue, and that is going to put premiums into some of the more advanced developers or those with real world-class assets. So again, pretty good situation in precious metals. Now, if we look at GDXJ, it's going along quite well. We'll take a look at that chart in a minute. But locally, we certainly saw a very powerful week for some select stocks. So let's just have a quick look at GDXJ. So I've just plucked one example. So some of the US majors, the top 2, 3, 4 US gold producers are really, if you look at the financial metrics, they're looking extremely attractive. And I've just selected one of the majors, one of the top 3. And when you look at their earnings, they've beaten in 7 of the last 8 quarters, which is a good record because, mining is a bit of an up and down sort of industry. It's very hard to consistently beat earnings expectations. If you look at the FY24 PE relative to their growth, it's way, way less than 1. Now, there are some forecasts 3 or 4 years out that those earnings come off the boil, and that may prove to be the case. And I think it's largely around declining resources, declining reserves. But then they can always address that through acquisition. But also the free cash flow margins are now up to 16%. So 16% of revenue is free cash flow, not just operating cash flow, but free cash flow. So these US stocks are nowhere near priced as they should be for the sort of growth that they're producing. So good news there. And in Australia, the index for the gold miners was up 7.6%, and we may see some further follow through next week. Just wrapping up on other commodities, copper was steady. Sorry, that should say steady, not up and steady. It was just steady. At $4.60, nickel was at $7.55. Of course, the news through the week that BHP has now put their nickel operations in Western Australia on care and maintenance was probably inevitable. Things pretty dire in the nickel industry. If we look at copper, the supply growth is only a fraction of what it was. So that's the rate that supply is coming on is just a mere fraction of what it was 10 years ago. We've got the top copper producers in the world, the mines that have been producing for decades. They're in decline, as is natural. And we've got the cost of capital is inhibiting new investments because mines are having to go deeper. It's much harder. It's much more costly. The really low-hanging fruit was plucked 2, 3, 4, 5 decades ago. It's getting harder and harder. So that's why the copper supply growth is just not coming through at a time when you would think with all the decarbonisation efforts and just natural growth in the world's population that there would be huge investment to ramp up supply. Just not happening because at the end of the day, companies invest to get a commercial return, not because community sentiment says that we need a lot more copper for decarbonisation. It works the other way around. It's got to be a commercial investment. And at the moment, and it's hard to see this changing, it's not all that attractive for major investment in copper. So I think it's inevitable over the longer term that the copper price will work its way higher just purely on supply and demand. WTI crude, West Texas Intermediate, was down a little bit, back down to 82.2. All right, wrapping it up. I think this is, and I've been saying this since the middle of 2023, that I expected the next year or two to be particularly good. I think this is time for well-organised aggression. It's probably been that way for most of this year. It's certainly the way that I've approached the market. And so I pose the question, does your portfolio pass any sort of reasonable health check? And I don't know how often investors actually think about that or whether they just stuff a bunch of stocks in there that they think they should own because that's consensus thinking and, it'll take care of itself. So I wonder how many investors actually stop and think about how healthy their portfolio is. So let me try and categorize it the way that I think about my portfolio. And I do this every week, every month, constantly in review, because being in stocks is very dynamic. Things are changing all the time. Things are improving. Things are going off the boil. So I would categorize my portfolio this way. Stocks that are in strong, short and medium-term uptrends, and they're still trending. And I've got a number in that category, and certainly in the Insiders Club, we've got a significant proportion of the portfolio doing that. Next category would be stocks in strong long-term uptrend. So we're talking, 3-4 year trends, but they're consolidating. And they might have gone up 5 or 10-fold, and then they've been consolidating for the last year, 2 years. But that's okay, that's normal. The resumption, as long as the business keeps progressing, that trend will resume. It just means you've got to wait a bit longer. Sometimes it can be a bit frustrating, but you just wait a bit longer. So that's the second category. And those two categories encompass the vast majority of what is in the Insiders Club core portfolios. And the third category are stocks that are underperforming and or stocks that are in serious trouble and really shouldn't be in your portfolio at all. So I'd really encourage everybody to think about how their portfolio is currently doing. You've just got to look at the price chart. It's not a difficult thing to do. Look at a weekly chart over the last 3 to 5 years. Don't look at the last 2 months. That's a misleading view. Look over the last 3 to 5 years on a weekly chart and just categorize your portfolio in that way and see what you come up with. You might surprise yourself. And I pose the question, do you even know what your portfolio is likely to deliver? All we have in investing is probabilities. There's no guarantees here. We've got probabilities. We can stack the probabilities very much in our favour. If you put in some work and you get organised and you execute consistently, you can stack the odds in your favour. You don't have to be a victim of whatever the market throws at you. I've got a very good idea of what my super will do in the next 5 years because I only deal in high probability situations. Do you know what your portfolio is likely to deliver to you in the next few years? Now, for most investors, that means that getting some help with some or all parts of this process is required. I'm in the very fortunate position that this is a full-time activity for me. I'm absolutely immersed in the markets. And so I have that luxury of time to devote, but very, very few people are in the position that I'm in and require other input or other assistance. You may not know the questions to ask. So there's certainly plenty of help if you want to go there. Portfolio analyst last week, we looked at stocks that you can build your portfolio around, the great long-term wealth compounders that have been giving for the last 10 years and will almost certainly keep giving for the next 10 years as well. These are the stocks that should be the cornerstone of your portfolio. We also looked at being beware of the hyped up newly listed ETFs, because when you think about it, when's a ETF manager going to list a new ETF? When a sector is really in favour or when it's not in favour and you can get a better price. So often if you buy into these ETFs when they're newly listed because that's a sector that's flavour of the month, then you may find that 2 years later you're still underwater because you just paid too much. Coming back to the point I made before, do you even know what your portfolio is likely to deliver? Well, if you want some analysis, that's what Portfolio Analyst does. You can come into Portfolio Analyst. There's a 2-week trial, but then beyond that, you can ask questions about your portfolio and you can get feedback about what the stocks you own are likely to deliver. That's the whole point of Portfolio Analyst. That's the commercial finished for the week. That's it from me. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.